This one simple mistake could be the reason why you are struggling as a trader. Before I get started, if you could give this a thumbs up and subscribe, it would be greatly appreciated. And if you found this content helpful, please let us know down below. Or if you have some video ideas, let us know what you would like to see in hopes that it helps you guys improve your trading. So the number one thing that I see that wrecks traders in really finding consistency is going to be, and I'll type it here, inconsistent risk size. And I will cover an example below of why inconsistent risk size is so detrimental to beginner traders, how to fix it, how to calculate your stops in a place that makes sense rather than just a random arbitrary number. And then you can start implementing this to improve your trading. I'll go into a little bit of when to start adjusting your position sizing based on data. So inconsistent risk size is the number one factor for inconsistent trading and no results for beginner traders. And this is going to be more tailored towards any traders who don't know if their strategy works, but specifically for beginners as well. Because we're going to go through an example here of what happens with inconsistent risk size. So let's say you're someone who takes, let's for example say you take 3 trades. So we're going to take 3 trades. And on the first one, number one, it's a loser. And let's say we lost 50 bucks, okay? And then into number 2, what a majority of people do is like they're saying, oh no, I lost. Now I have to lower my position size because I'm scared of losing. But now is the winning trade. You make $20, so this is minus 1R. And $20 plus 2R. So you made 2R on this second trade. And what you want to do then is on the third one, and actually let's go back here. This is going to be you're risking $20, but if you make 2R, then you're going to be making $40 here. And then on that third trade, you're like, okay, I'm feeling good. Now I'm risking $50, and now I lost that $50 or 1R. So what is our total going to be? So you take minus 50 plus 40 minus 50. And what you're going to see is you lost $60 on these 3 trades. Now, let's, for example, say you took these exact same 3 trades with consistent position sizing. So in this particular example, if we lost 1R, so now we're going to be doing constant risk sizing. So we're risking the same amount per trade setup. So this first one, if we lost 1R, we're going to still lose $50 because that's our risk amount. But let's say we risk the same amount on this setup that we win 2R. So if we risked $50 and we made 2R of that or 2x of that, now we made $100, and then that last trade we still lost 50 because we lost 1R. Well, this comes out to $0. So by having this constant risk sizing, you just saved yourself $60 off of this move. And this loop right here is so common for beginner traders where they think that I have to lower my position size and adjust my position size after a loss because I'm fearful, and then after you win, now you're trying to adjust your position size more. What you should be focusing on at the beginning is finding that consistent risk size. And let's say, what is your risk tolerance? So let's go in here and let's go into that consistent risk tolerance here. And let me go here and let's go into consistent risk level, we'll call it. So let's say you have a $1,000 account, okay? And you want to risk 5% of your account. So you want to risk 5% of your account in each trade. Perfect. Now you're going to be risking $50 per trade. Now we're not going to start just adjusting this and randomly say risking $20 because I've lost 2 trades in a row. That is going to happen. What you're going to do is every time you're going to try to get as close to risking the same risk amount in this particular setup until, here's the kicker, until you know what works. And until you know what works, you want to keep that risk size the same. So if you know what works, then you want to size up in your best setups. For me, an example is I know if we gap up over structure, I have a much higher likelihood of the trade working. And that's proven through data. So an example then is, okay, on gap ups over structure, I'm willing to 10x size. So let's say if we have a move that's just a flat gap or a down gap, I'm not going to risk the same as a gap up with structure, because I know statistically that gap ups with structure, I have much higher likelihood of that working out. Now, that goes into, you don't know what you don't know. If you don't know if your strategy works, there's no reason to be position sizing drastic changes, because you don't know what works in the conditions when that strategy works best. So until you are able to do that, your consistent risk level is going to help you a ton. A lot of people out there will preach varying risk size and adding more size on your best setups, but if you don't know, then how are you supposed to do that? Because you don't actually know until the data says so. So how are you going to get to the point of knowing? You're going to start journaling. So the first thing you're going to do is journal. Second thing you're going to do is basically tag your strategies. And then third, you're going to review what are common themes of winners versus losers. An example might be, let's say you notice your losers are when market is in range, for example, and your winners happen in trend. Well, now we can go in and say in trend, and data confirms this, then I can size more. You want to know, and until you journal and do all of this work, you'll have no clue what works. So using inconsistent risk sizing is just hindering your performance. So the fix is consistent until you know and tag your strategies and you know what works. Now, I wanted to touch on 1.2 that a lot of people get wrong is where to place your stop. A lot of people will just use some random arbitrary like 15% and have no idea what the structure of the stock is doing or anything. They're just putting a random 15-20% stop on an option contract when the structure could still be valid on the given setup. So let me go into an example here, and I'm going to be covering NVIDIA, and we'll cover this so that you guys can see what I mean by this. So what you want to do is your goal, and I'm going to put this down here, your goal right here. So goal is to place your stop loss where trade thesis is invalidated. Not just some random, let me go back here. Not just some random 20% loss because you don't want to take more than a 20% loss. You want to go where your trade thesis is invalidated. So let's say we're a trend trader who's trading structure. What we're going to want to do then is, if you know, and in this case is a downtrend, you'll have a series of lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Well, okay, this is that first leg down. Here's that first attempted higher low. So if we're entering at this candle's low, it would be a great spot to put your stop right here, because this is that potential lower high that if we roll over, you're catching this move, and in essence of a trend, you're catching it right here. So you want to place your stop for that structure if you're a trend trader. So let's continue going lower. Now we bounce. This is our new pivot. Now we bounce. This is our new pivot here. So if we're entering on these bounces, we're setting our stop loss where this structure is invalidated, because on this example, where does that structure get invalidated? When we start putting in a higher low and break that prior pivot. So continues, structure still in play, structure still in play, structure still in play, still in play. Where do we potentially flip? Right here. We make a new higher high. Now, do we come and barely wick out these lows before continuing? Yes, but you're never going to perfectly time a trade. The point in the matter is you want your trade or your stop loss where your thesis is invalidated. So in this trend, you got invalidated right here. You could sell your runners right here because that thesis is invalidated. Now, again, if you're catching these pops in this downtrend, you want to manage your risk, set your stop loss where that structure would be invalidated, because then that would be a potential flip of trend, and that's where your stop loss would be. I hope this video helps you guys. If you could please give it a thumbs up and subscribe, it would be appreciated. And if you're interested or you have any ideas for next videos to make, feel free to let me know down below. Thank you guys so much, and I hope you all have a great day.